Well, I mean, there's a lot actually going on there. So, for instance, I know for a fact that short-term bonds have just been, issued. Sorry, the approval process for short-term bonds, which is anything up to 3 years, has now been approved to allow, FMDQ effectively intermediate the process for then FMDQ to then submit to SEC after it's been done and closed. So there's a lot going on in terms of the issuance process. We also have stuff to do with private debt or private debentures. So in other words, bonds or debt securities that are issued by limited liability companies as opposed to public limited companies. So we're working on that also. FMDQ has done a lot of work on that. And we think that from the issuance perspective, I think we're moving quite frankly in the right direction. The things that begin to become that we need to start looking at, in terms of changing things like, for instance, fee structures. Say, right now we have a one-size-fits-all. So our regulation states 1.35%. We're saying if you look at much bigger transactions in terms of size, 100 billion or so, 1.35 makes sense. But if you're looking at much smaller transactions, which is the bulk of our transactions, 5 billion, 10 billion, or even less, 1%, which is, if you're lucky, you get 1%, even sometimes 75 basis points, shared by 3 or 4 houses. It's not a sustainable way of running this sort of company. So those are sort of things, we would look at some sort of matrix type structure where you have, from a band to a band will charge X, from this band to this band will charge Y, and so on and so forth. The other thing that is, might be of interest, say, well, should the fees be regulated by the Securities and Exchange Commission, or should the Securities and Exchange Commission assign such a role to the association? You guys set your own fees. If your fees are outside markets, then the market wouldn't come to you. So the association can then set sort of like fee guidelines, notify SEC, and obviously it's set and agreed by members, and it becomes a new way, a new paradigm of doing business. Like I said, if you go outside the rim of what the market desires, then you'll be the first to know that, because obviously your business volumes will drop. So that's that. But more importantly, is also to look at the industry as a whole. If you look at, right now we have a sort of single license regime from SEC. So there's an issuing house license or an asset management license or so on and so forth license. And what we're trying to say to ourselves is, a lot of houses today more or less have more than one license. I mean, you have a few that have just one, but most houses have, a basket of licenses. They're trying to trade bonds, they're trying to basically link the whole industry from an origination, distribution, trading perspective. So from that perspective, what we found, is that just like any company, you've got capital, right? Or let me say a company or a company balance sheet. You have capital, you have assets, but there's one lacking part of that balance sheet. How do you create the liabilities on the assets? In other words, how many balance sheets have you seen, right, that don't have liabilities funding their assets? All right, so how do you expect the industry to evolve where they don't have they don't have the ability to create liabilities, for growth, or that allow them to actually leverage their capital for growth? Again, these are some of the changes that we will be looking to attain. repo markets, which again dovetails to what I've just talked about. Creation of repo markets. Repo markets are generally globally how broker dealers fund themselves. We have a semblance of it in the guise of an interbank market. What can be done, and we don't have to go into details here, but there are ways in which it can be structured to allow non-bank financial institutions have access to that, for them to be able to create the right liabilities to fund and grow their balance sheets. So if we're trying to create, an intermediation market, a financial intermediation market that would have an impact on the Nigerian economy in the real sector. Yes, you want to have fluidity in the movement of securities from buyer to seller with as little friction as possible. So the cost of transaction is reduced as possible. However, one needs to also look at that in the context of the volumes that occurs. The truth of the matter is, when we look at fee costs, and I'm just going to swing from secondary now to primary, and we talk about, you shouldn't charge them 50 basis points, 70 basis points, etc. That's what people charge offshore. You forget that people are charging that on a minimum issuance of $500 million. For a bond to qualify as liquid, at least just barely liquid, $500 million. The bonds we do here are a smidgen of that, size-wise.
Has dialogue commenced? Do you have any timeline you're looking at for the completion or actualization of this action?
I said, we're having our first meeting with the Director General of the Securities and Exchange very soon. We intend to have several meetings. To be honest with you, from our perspective, the way the association was being before, and I'm not, this is sort of concentrated on, events and where people dialogue, events and that, which I think from our perspective, we're saying that let's take a detour from that approach, and let's really focus, on trying to change the way we and our regulators approach the market. Rather than events, let's engage our regulators. If we have to put monies together to fly out to countries to go and look at how things are done and come back and document the way we work here, let's focus on that. So the money we use for an event, we'd rather use it for that. What we want to do is to accomplish at least some change within the way within which our industry works. We would like to create employment. We would like to, see medium to large, scale corporates having access to equity financing, having access to long-term debt financing on a regular basis. We would like to create interest rate swaps. We would like to create, all kinds of instruments that actually impact positively, the real sector of the economy. That's the kind of thing we want to do, and do that with pride and joy. Anybody in my industry will tell you there's a lot of pride when you put up a paper and see a transaction that closed and worked on for 6 months or a year and closed. We enjoy that. That's our joy. So what we want to do is focus heavily on getting our regulators to understand that if you don't engage us and understand that, what we have here is enlightened self-interest. Our industry has to survive. We have to grow it, and we have to grow it organically.